Okay, so quick introduction of myself and introduction into algorithmic trading. So my name is Martin Weiser. I'm a software engineer for a big data company out of Silicon Valley called Splunk. I live in Winter Park, Colorado. I've been to a couple of the in-person meetups. I've been trading algorithmically since about 2006, and my first really good profitable system was around 2008 when Amazon AWS introduced a thing called Amazon Web Services, and we'll get into more details around that. I ended up on the trading side through poker, so I played a lot of online poker before, and that's how I got started. And 2008, 2009, I did fairly well. 2010 was the flash crash, if anybody remembers, May 6, 2010. After that, I had to get a home equity line of credit. I had so many option positions I couldn't get out of at a fair price. Had to settle that, so that was pretty crazy. Anyway, so I had many, many good years, and then 2013 came along. 2013, we moved from Denver. We lived in a place in Littleton called Roxborough, and moved up to Winter Park. And we basically sold our house for, think of X dollars, and we bought a house for like 4 times X dollars. So we highly increased our house price. And in that year, I blew about 200 grand. And that's after, if you think of my day job, probably about producing around 300 grand a year. That's after the 300 grand that my day job produces. So that was a really bad year. And the reason why I'm bringing this up is just because you're trading algorithmically does not mean that a lot of the issues that you have in trading, go away. Like, if you turn it up to 11 and you roll the dice, it can definitely backfire. From a tax perspective, I file what is called trader tax status, which allows me to do mark-to-market accounting for equities and for options. Now, I don't really have a claim to fame, but if there was anything like that, it would be this. So some folks may be familiar with this website called Collective 2. Collective 2 is a marketplace where you can buy and sell different trading strategies. So I can say, I'm an investor and I'm looking for a stock system, and the stock system should be 100 days old. And, I see a bunch of different systems there. I can drill down into those systems and, see what the profit factor is, how much money this thing makes on average. And basically I can subscribe to this particular system for $49 a month. So my first system that I published on Collective 2 was this one here. Like I said, I played a lot of poker. So there's a guy, his name is Doyle Bronson. He had a book called Super System. I called my super system Extra Large. And what I did with that is I basically charged $200 for it, and you guys see the performance there. So this is all non-leveraged. And I traded that for 4 months basically. And then the 5th month, I had a fallout with the Collective 2 guys. For a couple of different reasons. But what this system did was, you see the green performance was my system performance, and the blue performance was if you put 250 grand into the S&P at that point in time. So the 250 grand would have grown to about, 265-ish grand. In my system, it would have grown to about 290,000. Now, what was interesting with that, and then the system was basically a machine learning system that highly curve fitted which equities it could predict the best over the last 2 years for the next 3-day cycle. And then it would just predict whether or not that particular equity goes up or down. And, this is all audited. And what was interesting was the system took off right away. Like, it made a ton of money. And after about 10 days, I immediately had a bunch of subscribers that were smaller hedge funds and individual investors. I had them subscribe to my system. So I'm like, wow, this is awesome. Like, everybody pays $200 a month. This may be another income stream. And on top of that, I can front run all the different orders, right? So I can submit my order before they can submit theirs. So it seemed like a win-win. But then eventually, like I said, I had a fallout with the Collective 2 folks because they raised the commissions too much. But I could kind of see how like some of those hedge funds would trade the system, and like they would layer in like millions of dollars into that system. And I'm like, wow, I mean, the system has a 10-day track record, and they literally, just pile the money in. So was kind of crazy. Anyway, just wanted to show that. That was pretty much the only system I ever published my signals on.
Hey, Martin.
Yep.
I'm sorry to interrupt you real quick. Is there any way that we can set this to where the guests can auto admit themselves? And it seems like we've got a couple on hold, and I'll just, I was trying to do that on my end.
I think all I can do is I can do the admit all. I'm going to keep this up on the front screen, and then hopefully it'll pop up. I'm not sure there's an auto admit. Like when we do this for work, the people typically join. There's no manual admission, I guess.
Okay, yeah, that may be my oversight, but I'll try to work on that for next time. But yeah, it seems like we got a couple people in the queue.
Yep, I should have admitted all of those, so they should be in now.
Okay, thanks.
So I had a travel job for pretty much 20 years. I came to the US at the end of the .com bubble. Initially, I lived in Chicago. So in '99, one of the first customers that I worked with, and I worked always in IT, so I always did systems development and stuff like that. I worked for a company called First Option Chicago, eventually got bought by Goldman Sachs, and I could go to the trading floor in 2000 and my eyes lit up. Like if you've never been to a trading floor back then, people had huge egos. They were swinging around millions of dollars. Like there was so much excitement there that I loved that place. And then end of 2000, I think maybe early 2001, we moved to Colorado. 2002-ish, we moved to Littleton. And like I said, about 7 years ago, we moved up to Winter Park. So there's a couple of industry conferences, and that sounds more fancy than what those things are. Those are like more trade shows. But there's one trade show called the Money Show and another one called the Trader Expo. And at one of those Trader Expos, I met this guy called Scott Andrews. And he was the gap guy. So basically his system was fading the gaps. So if a stock closed at $20 and the next day it opened at $20.20, you would sell it at $20.20 and assume it goes down to the previous day's close. So it goes down to the previous day at 20. If it opens the next day at 1980, you would buy it at 1980 and then would assume that it goes up to $20 before it does anything else. So it was just fading the gaps in the S&P and the NASDAQ 100 futures, and also in super highly liquid NASDAQ names. So Intel, Cisco, think of those names. And a lot of people were trading that manually in 07, 08. So people would look at the screen, would wait for the open tick, and would basically pile their orders in, like all the day traders, all the traders that would do that would work for various firms. So I had this tech advantage with that AWS, with that Amazon Web Services. So what I would do is I would provision a server on the East Coast, really close to the exchange, wait for the open tick, because one of the challenges is you don't know, is it going to open below or above? You see it on the futures, but you don't necessarily see it on a highly liquid NASDAQ name. So if Intel, is trading at $20 and before, the bid and the ask is below the $20, you would assume it opens below, but then the first trade may still be above. So what you'd had to do is you had to wait for the first trade to come in, take the open tick, and then fade it and immediately put a limit order in. And with that system, like I said, I immediately got super lucky. Like the winners were more than the losers, but the winners were also significantly larger than the losers. So on a daily basis, this was like more than double my income. So it was a really good starting experience. Now let's start out why people want to do systematic or algorithmic trading to begin with. So and what is it? So in systematic trading, you don't just look at a chart. There's a lot of gifted traders that can look at a chart and know whether or not the stock goes up or down, or think they know whether or not it goes up or down. But with a systematic approach or with the algorithmic trading approach, you basically follow a predefined set of parameters to get into and out of the trade. Now, this can be automated all the way, up to the execution. This can be semi-automated, or this can just give you a signal that says, hey, tomorrow morning, buy this particular stock and sell it, at a later point in time. There's very little room for discretion. Discretion is mostly in the terms of position sizing. So if your system performed really bad, you could say, hey, based on the back testing, it should come back, so I'm going to increase my position size. Or you could say, hey, maybe I shouldn't increase my position size because it's performing that bad. Maybe I should reduce it. So obviously there's always a little bit of room for discretion. But otherwise, the entry parameters, the exit parameters are all clearly defined. It's also what a lot of the high frequency traders do. So they sit on the bid and sit on the ask on certain exchanges and cross the spread in between. And that's a strategy that as a retail investor, you cannot compete with. But the lure of it is it's available in all the markets, in commodities, in stocks, in ETFs. It's available in all the different time frames, in minute charts, in 5-minute charts, in 15-minute charts, in daily charts, whatever, all the different position sizes. And if you think you have a small edge, it's the ultimate casino. It's like your ATM, your way to extract the money out of the stock market. Now, that is what systematic trading is. Now, why would you want to do that? In theory, you would want to do that because it removes the emotions from the decision making, and we'll get back to that. So that's probably the biggest hype around systematic trading or algorithmic trading, and that's absolutely not true. But what is true is you have some quantifiable results that you can always compare to the history. You can always say that this is something that happened in the past, and therefore it's more likely that it'll happen again. And in a perfect world, you build a portfolio of completely non-correlated strategies that outperform the benchmarks. So you have significantly less drawdowns, which makes it much easier to stay with that system. And because it can be completely automated, it could be really the entire freedom from a financial and from a mental perspective. So those systems, for me, for example, they run completely automated for the most part, unless the system is in development or in test phase, and they trade on their own unless they fall out of the risk parameters. And I like to compete, so I do a lot of mountain bike racing. I don't mind getting beat or whatever, but I like the trash talk aspect of it. I like everything. And to me, this is the ultimate playground. It's like, what was the movie Hunger Games? It's you against the rest of the world. So it's the ultimate hacking playground or the ultimate riddle to solve. So those are the main drivers why I think systematic trading is really cool. Now, what do you need to get started? Well, a lot of websites will tell you you need a good process, but more important than a process is you need an idea that actually passes the sniff test. So looking at something and saying, I'm going to buy this when it's oversold, and I'm going to quantify oversold by the relative strength indicator, that's potentially the idea. So what you want to do is you want to have an idea that at least looks very promising when it comes to execution. You don't just want to say, hey, buy on September 10th and sell on September 11th. And that's my idea. And then, some years you may get lucky and other years you may not. Then what you also need is a backtesting platform. So I do all my trading in Java and in Python. And for that, you need historical data. So all my data is in a MySQL database. There's about 7,000 equities in there for about 20 years, daily quotes for those equities. So those are equities that I can short sell on Interactive Brokers. So that's how I get the list of equities to begin with. And once you have those two, you can decide, do I want to start with a slow and a rigid process, or do I want to roll the dice a little bit and kind of live trade the system as I'm actually coding it? Now, if you start very slow and very rigid, what you would typically do is you would start out building a backtest. You would say, okay, I'm going to backtest this on certain equities. And with that, you would very clearly understand your risk parameters. You would understand what drawdowns can you expect. Does it perform better when the SMA, when the simple moving average is above a certain threshold? When it's below a certain threshold, you can optimize it. You can say, okay, does it work better on smaller equities, on things that may have a stock price up to $10, up to $20, up to $50, or does it work better on high flyers, on stocks that are above $200, for example? Then you would paper trade it. You would make sure that the paper trading results compare somewhat to your backtesting parameters, meaning, okay, in paper trading, I found this trade. Does it backtest? Do I find the same trade? And eventually you would go live with that system. Part of the problem with the slow and the rigid process is that you're wasting a lot of, or you're spending a lot of time doing the back test and the optimization phase. So this is literally, this can very quickly be a couple of months or so where you're not doing anything. And this is very boring. So what I like to do is I like to, go with a more agile approach that is also significantly more error prone. So you kind of eyeball the trades and you trade them live, but initially you do a manual execution. So you scan for the results, but then you execute it manually. And then eventually, you extend the automation. So then you basically start automating the fills, automating the execution, the buys and the sells, and then you do constant improvement. What the agile approach gives you, it immediately tells you if there is a major issue with your trade idea that otherwise you wouldn't necessarily find. So like I said, the 7,000 equities that I have in my database, they're all shortable, for example, with interactive brokers. However, if a certain equity goes down for like 3 or 4 days, there may be a short sale restriction that you don't see in the data. So when you manually trade it, you would immediately see that this is going on. Versus if you just build the system in a vacuum, you wouldn't know that this particular equity is actually not shortable on this day of the week because it went down like 3 days before that. And therefore, you can't just pile onto that momentum trade. So there's benefits and disadvantages for both of those processes. Like I said, I don't mind, there's not a lot of edge out there where like every trade will go wrong or every trade will go right. So I don't mind, doing smaller trades and actually putting some money to work and just figuring out what works and what doesn't. And at that point in time, seeing those trade idea issues. Now, one of the major pitfalls with algorithmic trading is you basically need to come up with a model that represents reality. And that model can be a stock goes up, a stock goes down, a stock goes sideways, whatever it may be. Like in this case, you would see that the black line kind of leads the red line. And if you would be able to know the black line, you could kind of predict where the red line ends up. Now, the human brain is very, capable of doing those things, and it's very straightforward to do that. But very often it makes wrong assumptions. Like in this case, you would say, okay, this definitely looks like the red line leads the black line or the black line leads the red line. But when you look at the underlying data, what this actually represents, you see that the red line represents the number of people who drowned by falling into a pool. And the black line represents the number of films that Nicolas Cage appeared in. So two completely independent data sets that have nothing to do with each other. And with algorithmic trading, this is a real problem. You see something, you backtest it, you think this is how it's going to work, and you see those relationships and you're like, yeah, man, I can predict the future, everything's good. And then it turns out that, it really isn't, and those systems don't perform well in a real life trading environment. Now, what do I use for my setup? I have 2 accounts. I'm super paranoid with those accounts. Like I'm always thinking that the brokers kind of look at the trades that you're doing. So one account, and that used to be my big account, was with Interactive Brokers. It was a portfolio margin account, and I have a live data feed there. What Interactive Brokers does is it gives you quotes sampled down to like 200 or 300 milliseconds. So when the market is crazy, with the coronavirus, for example, or May 6, 2010, when the flash crash happened, Interactive Brokers gives you a constant feed of quotes. Like it's never going to be overloaded. It's a really good brokerage. It works really well. They have a Java API. They have a Python API. It's a real pleasure to work with them, as long as you don't have to call customer support. Customer support is terrible with them, and they also did not participate in the zero commission type activities that all the other brokers do. So then I have now my bigger portion with TD Ameritrade. I also have a live feed with them. Their live feed is tick based. So when the market goes crazy, sometimes your live feed is literally lagging 2 or 3 minutes behind of what the actual data is. So like I could literally look at Interactive Brokers and futures are like 2 or 3 ticks higher, no, not ticks, actual points higher than they are with TD Ameritrade sometimes. But bottom line is, the reason why I do this to some degree is I do a lot of pairs trading, and we'll get into that in more detail. But with that, I can put all my longs with one broker, all my shorts with another broker, and that way kind of no broker has the entire visual of a position. And then I have a small account with TastyWorks. Then I use Google Sheets, and I use that for accounting for two reasons. One, because if I look at one broker or the other broker, it just gives me half the story, so I cannot see how well a strategy actually performs. So within my Google Sheets, I can look at certain tabs which represent the different strategies. But also when I'm traveling, I can just pull it up on my phone and see how well those things are doing. So I don't need to write like a mobile interface or anything like that. Google Sheets already has a mobile interface, and I use the G-Spread Python API to basically update the quotes every 10 minutes and just see how those things are performing. Now I have two servers with a company called VPS Time. Each server is about $14 a month. And I do have a data feed with a company called Quantopian, and that gives me daily historical quotes. Now, Quantopian and portfolio margin are probably two very unfair things compared to the rest of the market. So I'm gonna work on the portfolio margin first, so you guys see what I mean with that. So in my opinion, margin is a superpower, or it can be a super curse, but for the most part, it should be a superpower. So let's go through this example, right? You have a trader, the trader buys a stock, let's say Apple goes from $100 to $200. The trader has, let's say the trader is Jim, right? Jim has $1,000. With $1,000, he opens a, like a Robinhood account. With Robinhood, you don't get, with $1,000 at least, you don't get any margin. So your $1,000 from the $100 with Apple goes to $200. So are now worth $2,000. So you make $1,000 on that, or 100% return on your investment. Pretty straightforward. Now John has the exact same trade on, but he has $2,500 to invest. With $2,500, you get what's called Reg T margin. And with that, you get 1 to 2 leverage. So with the $2,500, John actually controls $5,000 of buying power. So he buys Apple for $5,000. It doubles, it becomes $10,000. So even though both traders made the exact same trade, John makes 300% on his money. So he makes $7,500 net gain on his initial $2,500 investment. So, that's slightly unfair. Now you have Mike. And portfolio margin is different with the different brokers, but with interactive brokers, you need like 100 grand in it. With TD Ameritrade, you need 120 grand in it, but you get 1 to 5 leverage. So think about it this way, right? The $100,000 with 1 to 5 leverage has you control $500,000 in buying power. So once this doubles, it becomes $1 million. So with your $100,000, you basically make 900% return, or $900,000 return on that investment. And that doesn't mean that you need to put on one massive position with 100 grand. You could spread this around 1,000 positions, 100 positions. So if you believe that your system has a tiny edge, you can spread that out, have as many positions as you want, and have that portfolio margin basically work for you. Now, the other thing that I mentioned that is somewhat unfair is the data provider, right? And unfortunately, it's not unfair for me, but it definitely is unfair for some of the other folks. So if I go to Quantopian, and you guys can see what the Quantopian site does is it has some core financial data like end of day stock prices and fundamental data, but it also has what's called alternative data sets. So this is where companies, for example, sell their frequent flyer or their travel data to hedge funds. So hedge funds know exactly when you work for a certain company, how many people flew on United Airlines, how much money they spend on United Airlines, and things like those. So you see how many Hondas were sold yesterday, how many Teslas were sold yesterday. Those are all data sets that are available on this Quantopian website. But as a retail investor, there's no way to access that data. So I tried to contact the sales rep, I tried to talk to them and figure out what the minimum requirement would be to get access to that data, and they wouldn't even talk to me. They're like, if you have to ask, you don't have the money to actually spend on this. So there's definitely data out there that represents more alpha than not. So this is that company that I use for the servers. It's called VPS Time. Like I said, so you get like a 12 gigabyte memory for virtual CPU, 60 gigs of disk space server for $40 a month. It's pretty cheap. They will shut that server down if you do back tests on it. Like you cannot hammer the 4 virtual CPUs on that server. So for any kind of back testing, I use my son's gaming computer, or I use the AWS, the Amazon cloud to basically do my back tests there. But for actual trade execution, this system is, or this service is super reliable. So I can definitely, recommend them. And like I said, the price is definitely right. Now, when you set up a server with them, obviously you want to be smart about this, right? Like when I log into my server, I have 2-factor authentication. This is a good amount of my net worth in those trading accounts. I don't want somebody to hijack my server and basically do something weird. Like if people log in at a different time that are outside of trading hours, for example, I get text alerts on the phone. I have the Google Authenticator, like the 2-factor authentication, not just on my phone. I have it also on my iPad, because there was a time when I had to get a new phone. And all my code was basically, or all my authentication code was on that phone. But luckily, I had a second server that was logged in, so I could basically react to that. But what you want to do is when you have algorithmic trading fully automated, you want to make sure you put security fairly high up there, since this represents, probably a good amount of your net worth. And even if it doesn't, even if it's just a small chunk of your income, it's still not fun, to give that up to somebody just because you set up your server in a non-secure way. I used to trade mostly in Java. Now it's mostly in Python. I use a lot of the TD Ameritrade REST API. They have 0 commissions, even on stock trades through the API. All the option trades are like 65 cents per contract, so they are also very cheap. Interactive Brokers has a Java and a Python API. They have really good commissions, and they by far have the best execution. So when you put on a trade with TastyWorks, with TD Ameritrade, and with Interactive Brokers, most of them get first filled at Interactive Brokers. Then the second most get filled on TD Ameritrade, and TastyWorks, I think, sells a lot of it to dark pools. So I get the worst fills on TastyWorks, but this is all manual trading. So take this with a grain of salt. I also use an indicator library called TALib. So I put the link into here. And what this one does is it basically has all the major indicators that you could possibly care about. So these have, this library, if you want to do a RSI-based system, you just look at RSI. It has a relative strength index. If you want to do something around MACD, it has all the functions already coded for you, at least the most common function. It's not as complete as like the TD Ameritrade interfaces, the Thinkorswim platform is. It's not as complete as TradingView is, but it's definitely a good starting point for many of those strategies. Now, in my opinion, the code base and the broker don't really matter that much. So, pretty much whether or not you go with TradeStation, with SOAR, with NinjaTrader, Multichart, Sierra Chart, there's a bunch of them out there. They all kind of, do the same thing. Now, I would say this for equities. I wouldn't necessarily say this for foreign exchange or for crypto trading. So with crypto, you always hear things like, well, it's not regulated, crypto exchanges get hijacked, they get hacked with foreign exchange trading. Some of them are less, they don't have as much money in the bank, so some of them will more likely fail. So obviously with foreign exchange or crypto trading, I've never done either one of them. I did foreign exchange trading when it was still legal with Interactive Brokers, and that was a solid platform. But if you do any of that, obviously you want to be smart, right? You don't want to go with a tiny brokerage house that gives you great commissions and then the company goes belly up and you lose all your money with them because it's a non-regulated entity. But for futures, for equities, for options, for anything that's regulated, I don't think there's a big difference between any of those brokers or any of those code bases. Some of them exist at a higher level, like Sierra Chart, Multichart, NinjaTrader, allow you to write the code a little bit higher. I like to write the code at a very low level at Python or at Java, so I can very quickly change the execution API and potentially, point it towards E-Trade or point it towards another broker. So I don't really, give up my logic, and I don't lock myself into any of those proprietary trading platforms. But there's definitely an advantage with some of those proprietary trading platforms, and we'll go into more detail there as well. So let me tell you what doesn't work for me. So what doesn't work for me are basically indicator-only systems. So there is all kinds of podcasts out there, right? There's a podcast called Trader Interviews. There's a podcast called Better System Trader. There's a podcast called Chat with Traders. Like, they all have all kinds of guys come up and tout their trading systems. There's magazines out there that highlight certain strategies. Many of those I try to backtest, and they come out with successful results. I test the same thing, and either I'm an idiot or I have bad data, or they just have something else going for them. But very often I cannot make those systems work. So I've never gotten lucky with the indicator only system. The next thing that doesn't work for me is a system that would work on all markets, meaning on commodities, on foreign exchange, on small caps, on large caps, on micro caps. So those are also things that I don't think there's that much alpha in the market that you can just point it against anything and it will produce a profit. Then in some of the books, you'll read that there's surefire arbitrage systems where you can basically buy an option that has more extrinsic value than what you're actually paying for. So you'd basically pay for the option less than what it's actually worth. And while this may have been true, before they had computers, nowadays when you scan all the different option chains, sometimes, you find where the mid price may be a surefire way to win, but you never get filled on that mid price. So when you put on that order, you will never get successful with that. And again, there's books out there that say how you just need to scan the options market. There's options out there where you can basically immediately book the profit, and I have never gotten lucky with any of those. Another thing I tried was, and I call this high frequency trading, but it really isn't, but it's the divergence between the stocks and the futures. So for example, you have gold and the gold spot market. You have RTY, which is the Russell 2000 future, and IWN, which is the Russell 2000 ETF. And when the market is super busy, those relationships run out of sync. Like the relationship between gold and GC would be 1,000 shares of the ETF would be equivalent to one gold contract, or 500 shares of IWM would be equivalent to one future, same with SPY. And what you could do is you could in theory say, hey, if that relationship goes out of whack too much, I'm just going to buy one, sell the other, and wait for this thing to reverse. Now, I tried this, I coded this, I went into the trade and got horrible fills. So I'm like, okay, so I guess I can't submit this at a market. So a lot of the orders I'm trying to submit, I try to submit, those are super highly liquid instruments. So I'm for sure not going to move any of those markets around. So I'm submitting that at the market price. So then I thought, well, what if I submit it at the limit price of the most recent tick? And with that, I found out that even though on my trading console, the price says X, it already changed way at the exchange, and my user interface was just lagging that much. So all of those retail high frequency trading strategies, I have not gotten lucky. There are some folks that are out there that are saying this still works on some of the crypto exchanges where you can sell Bitcoin, for example, on one and buy it on the other. And basically bank the difference, but I'm not sure that this is actually true. The next thing, are highly curve-fitted systems. So if you look at a system and you optimize it with different moving averages, and you come out with a system that looks really good in back tests, that most likely also won't work in a real-life trading environment. And then some systems that are using leveraged shorts, like SSO, for example, or many of these short ETFs, they also don't work well because the holding costs are so significant. Like in theory, you could just short, some of the volatility ETFs, for example, like UVXY, but holding that is just, you're giving up 80% on brokerage fees just for holding those short systems. So none of those things work for me, but that doesn't mean that, they don't necessarily work for anybody else. Like I said, especially those successful systems on some of those websites, like many people say, well, works great for them. Like I said, I cannot make some of them work. Now, what does work for me is things like these. So first of all, every single system, every single algorithmic trading system will have a little bit of a time decay, meaning it will perform less and less over time as more and more people figure that particular system out. So I have a dynamic set of systems. So some systems do well when the S&P is below its 200-day moving average. Other systems do well when the S&P is above the 200-day moving average. So I basically fade in and out of some of those systems. And you can say that there's some discretion here, and there definitely is. But at the same time, it's also like Darwinism. Only the strong systems survive, and if they survive, they can play, and the other ones, they just get retired eventually. Then I have a lot of systems that work with market or sector segmentation. So the system may not work on all stocks, but it may work on stocks that are below a volume of, let's say, 400,000 shares. Or it may work on commodities, or it may work based on the market cap of certain companies, right? So some folks say, well, you're kind of curve fitting your system into the market, and this may be true. But another way of looking at this is that there is not that much alpha in the market that it would be available in all the different markets and in all the different time frames. So the way I look at this is I'm basically just finding the best candidate for that system. One of the systems that I had a lot of fun with around 2010, but then I got some, ethical thoughts around this was chat room faders. So on one of the podcasts, I heard this guy. His name was Trader Stewie, and eventually I met the guy. He's out of Seattle, but he has this website called Art of Trading, right? And in that, he has a live chat room. So basically, he has about 500-600 people in his live chat room, and the way this works is he says buy this stock. And then he puts it in the chat room, and then 500 monkeys basically try to go to their trading platform and enter that. So what I did was I faded that trade. So I basically, when he said buy, I sold it to all the chat room traders, and then 5 minutes later, I would buy it back. And you would have 9 out of 10 winners. So it worked really well for the most part. But then when I met the guy, I'm like, man, I'm kind of, taking advantage of his entire user base there. So I had some second thoughts around this. And I haven't really had any other chat rooms out there where I could, basically do similar activities against that. But that was definitely a fun system. And then, sometimes this guy's a momentum trader. So sometimes he would just jump on a stock and I would sell it. But then there's like a whole lot of other, momentum traders also piling on that stock. So my losers were definitely wiping out like 3 or 4 of the winners. But this was definitely something that at least worked when I was trading that particular system. So I would assume this still works. So this chat room faders is definitely something to explore. And obviously, the higher the following, the bigger size you can put on. The system we're going to take a look at today is called Rsi 2. That also works. It has really good results, but it also has huge drawdown. So I don't trade that system. So what's fairly interesting to me lately is not really looking at the signal in the noise, but just trying to make really a profit based on the noise rather than the signal itself. And in the no commission world, this may or may not be doable. So those are all scalping systems where you martingale in, you double your position size, you double your position size again, and you're just trying to, look at the noise when it comes to those trading systems. So that's where I'm spending most of my time, since most of the brokers introduced this zero commission type thing. Now, when it comes to system scoring, most people initially gravitate towards the overall, profit on this particular system. This is probably the least important factor when it comes to system scoring. So when you backtest a system and the system says, I made, on average, let's say $10,000 over 5 years, this looks like a good number. But if the system looked something like this, sell on September 5th, buy back the stock on September 20th, if you guys remember September 11th, 2010 or 2001, that system would have made a huge profit. And all the other days, all the other years, it may have, worked or it may not have worked. But that one year, that one average completely may have skewed your system results. So when I look at trading systems, and it wouldn't have traded much, right? Like half the time you would just be sitting on your money. So that's not a system that I would be interested in. So when I look at my trading systems, I need to have at least 5 trades a week. I need to have ideally at least 10 trades a day that the system finds. And the more it finds, the more positions I can put on, and the lower the risk can be on a per position basis. So here are my parameters. It needs to have at least 5 trades a week. The holding period needs to be, ideally less than 2 weeks, because the longer you hold, the more uncertain the times, get. Especially, you look at what's going on right now. Nobody predicted this, early January or late December. So, if you have a system that holds for 3 or 4 months, your profits may get eaten very, very quickly. When you look at the trades and you look at the average per trade and you look at the median per trade, which are 2 different numbers, right? You want to make sure that those are really close to each other. If the median is, let's say, $10 per trade, but the average is like $75 per trade, something highly skewed is going on. So you have one outlier, one lucky, trade that may significantly move up your average. So that's not something that's really sustainable. And if you would miss that trade, you may actually have a loss, right? So what you want to do is you want to make sure that you always have an edge, and that edge should be very reflective in the median gain, and it should be very reflective in the average gain. And then, you obviously want to backtest that system and see how many days, how many weeks, how many months are profitable. The more that are profitable, the easier the system is to trade, the easier it is to stick with that system. You want to understand what is a drawdown period, right? Like, how did it perform during the financial crisis in 2008, 2009? Did it make money? Like, when you look at the high point and you look at the low point, what is that time period? Is this in worst case 9 months? Is it less than 9 months? Is this 5 years where you can trade that system, or where you need 5 years to come back from a drawdown? Those are all parameters that make system scoring very, very valuable. And then at the end, you want to have as little correlation to the S&P 500, because if all you're doing is levering it up to the S&P 500, you may as well just buy the micro futures or the mini futures or whatever. And then one other parameter that I use is how many modules in my code will be reusable. So if I trade options, do I scan for different option chains? Is this something I can use potentially in other systems? So at least if the system doesn't work in a real life trading environment, at least I can reuse some of the modules and don't have to develop them for some other systems where I may also trade some options, or I may look at some execution algorithm that looks between the bid and the ask and tries to get the best feel on penny options, for example. So this is my system scoring criteria. But again, you want to make sure it trades often. You want to make sure that the average and the median are close together. And you want to make sure that the drawdown isn't, going on for years and years, because otherwise, it's very hard to stick with that system. Now, what are some of the most common pitfalls? I don't know how often I had coding errors where I had a look-ahead bias or a data snooping bias. And, I literally thought, oh my God, I just found a gold mine, right? Like, I may as well drive down to Denver, look at what kind of Lamborghinis they have, in stock, because I figured this whole thing out. Now, in reality, you always have a coding issue. Like early on, this was super frustrating because you go from a super high to like a super low. But eventually you take it with a grain of salt. Like now when I see a system, that has a really good profit and loss line or a really good backtest, and I'm like, yeah, probably look ahead somewhere. So when I talked about that system earlier, right, with the fading the gap, that system still backtests really, really well. All you need to do is fade the opening gap on the NASDAQ 100 stocks, and you'll have a winning system. But here's the problem. You don't know what the gap is, right, until the market actually opens. So when you backtest this and you assume you get in on the open price, you basically assume that you know, is it going to open up or is it going to open down? And the bid and the ask, even 2 minutes before the open, are not an indication if the stock is actually going to go up or down based on the previous day's close. So, this is one example where you look at the data, you look at the back test, and you're like, man, all I need to do is submit an order on open. It needs to be in 5 minutes before the exchange open, because otherwise the broker cuts you off. And that's a system that actually doesn't work that way. So you're doing some data snooping. You're taking a data point from the future to make a trading decision now. And that's not valid in a back test. So you'll end up with a really great backtest result, and you try to live trade it, and it'll not match the results at all. The next problem that you see with algorithmic trading is sometimes you miss the entry or the exit, right? So let's say you get a signal, and the signal is, go long that stock, and the stock is trading with, let's say, a bid of 20 and an ask of 20.01. So you submit your limit order at 20.01, you try to hit the market, but by the time your order gets in, the stock is trading at 20.01, 20.02, so you missed your entry. So what do? Do you chase it up? If you chase it up, if it is a winner, it's going to be a smaller winner than what it would show in the back test. If it's a loser, it's going to be a bigger loser than what it would show in the back test. So those missed entries and exits are really, really hard to code for. The next problem that you'll have is partial fills. Let's say, based on your position size, based on the money you have, you put on an order for 300 shares, you get filled on 200. What do you do with the remaining 100? You can, adjust the order, but then the fill price is spread between the two actual prices. Or you can say, well, I got filled on 200, so I'm just going to write it out that way. But that also highly affects how those systems backtest compared to how they trade in real life. One of the problems that a lot of people ignore is dividend adjustments. So especially if you trade S&P 500 stocks, many of them will have dividends. And if you stick with paid for data providers like this Quantopian website that I mentioned before, that's all taken care of in the actual data feed. If you go to Yahoo Finance, a lot of people complain about the data quality. Yahoo Finance actually has some really, really good data out there. For a long time, I used to just download the data from Yahoo Finance and basically use that. And they definitely have dividend adjustments. But the dividend adjustments only exist on daily data, meaning if you're trading a gap trading system on a minute data, on a 1 minute chart or on a 5 minute chart, basically it does not account for the dividends that may have been paid from the previous day to the current day. So what that means is that, let me just make sure that there's nobody else in the waiting room. Nope, looking good. What that means is that if you have smaller time frames, if you get smaller candles, like with interactive brokers, you can ask for 1 minute or 30 seconds or 10-second candles or whatever, that data does not adjust for dividends. So those are things that you need to be aware of. If you use any of the higher level trading platforms like TradingView, like TradeStation, you need to understand if the data already includes the dividends or if it doesn't, because it otherwise highly affects your backtesting result. It highly skews that data. So those are things that I ran into in the past. So now let's take a look at this RSI 2 system, and I'll explain why I don't trade that system anymore. But I'll share that slide deck. So here's the system explanation. So the guy who invented this relative strength index indicator, his name is Larry Connors, and he came up with that system called RSI 2. So the way how this strategy works is it basically looks for a stock in an uptrend. So here we can look at the code a little bit. It looks for a stock in an uptrend, and then it looks for a reversal of that stock. So basically what it does is it says the S&P 500 has to be above its 200 moving average. It's 200 simple moving average, which means, the S&P is in a bull market. The stock or the equity itself has to be above its 200 moving average. So that particular equity has to be in a bull market. And then the RSI2, meaning the relative strength index, has to drop below 10 for the last 2 days. So what the theory behind the system is, you buy in an uptrend after a short corrective period, right? So pretty straightforward. Now, what this system doesn't tell you is, well, when do you sell? Well, one way to sell is if the RSI goes above 80, right? That's one way of selling. Another way of selling is if it just closes and you are in the green, you made some money on that stock, right? That's another way of selling. So it doesn't really define the sell criteria really well. What it also doesn't do is it doesn't tell you, should you buy at the open or should you buy at the previous close? So let's say today Apple matches this criteria. I cannot buy it at the close anymore because the market is closed. So what I can do is I can 5 minutes before the close get a real-time quote and assume that because it's 5 minutes before the close, it will close somewhere in that range and put the trade on 5 minutes before the close. But if I do that, I'm not going to be filled at the close price. I'm going to be filled at whatever price I put the trade in. If I want to be filled at the close price, I would have to submit my orders at least 15 minutes before the market closes, because otherwise the brokers don't accept the market on close orders anymore. So, well, then you're going to take that snapshot of that price 15 minutes before the close, where there's a higher risk that it's wrong. Like you may get a signal, you enter the trade, the broker submits that order, you cannot cancel that order for the last 15 minutes, and then it drops the last 15 minutes, or it goes up the last 15 minutes, and all of a sudden the initial condition that you thought you had no longer exists. So that's a look ahead that you basically can really quickly identify, but it's very hard to avoid. Or you could buy it at the next day's open. But when you buy it at the next day's open, you need to have a broker where you can actually submit a market on open order before the stock market opens, right? So it's very tricky. The next thing is, how much do you buy? So let's say you have $10,000 to invest. And let's say like 3 symbols, 3 shares or 3 different stocks match that criteria. You can say, I'm taking my 10,000, I'm dividing it by 3. So basically I'm going to put $3,333 into every position. But then let's say you have a stock like Win and a stock like Starbucks. So if you look at, Win, for example, it's trading around $71, and you look at Starbucks, it's trading around $72 right now. So initially they both have the same risk criteria, but then you look at Starbucks high was like $99. You look at Win's high was like $200. Then you look at, Win has a beta of 2.5. Starbucks has a beta of 0.65. So in theory, you would buy, 5 times the amount of Starbucks that you would buy the amount of Win, just because the stock acts more aggressively. So it's not just based on the share price. It may potentially, you may want to include the beta in that. And then one of the big problems with that system is, it basically pyramids down. So if a stock does really poorly, you get the signal on that stock on the first day, on the second day, on the third day. So on the third day, you have like 3 positions on the same stock. So in your back test, you most likely have what's called survivorship bias, meaning the data of stocks that went out of business doesn't exist in the data set anymore. If you did that trade on Lehman Brothers or you did that trade on Bear Stearns, you would basically have blown up your account. If you do that trade, basic system here on Boeing Aerospace, you would put your first position here, your second position here, your third position here, your fourth position here, your fifth position here, your sixth position here. So at this point in time, you're trading at $95. Your first trade, you went long at like over 300, or I guess if you just do it above the 200 moving average, you would just do a subset of that. But you see the drawdown that this system basically generates. So it's really tricky to trade that system. Now, is the system profitable? It definitely is. It has a higher return than the S&P. It has a lower drawdown than the S&P, but it still makes it very tricky to trade. So there's one more guy coming in. I don't really trade that system anymore, even though, in theory, it would have some really good risk parameters. So the biggest disadvantages of this particular system is, it has the biggest drawdown at the end of the bull market. So if you increase your position size, right, like as you get more and more equity at the beginning of the bull market and you increase your position size, so let's say initially you start out with like $5,000 per trade, and then, your account grows and then it's $6,000 and eventually it's like $8,000 at the end of the bull market. All of a sudden, all your losers are going to be measured based on the $8,000 position size. So it's really, really tricky to mentally manage that. To me, this system has very similar characteristics to index option selling, right? Like you look at TastyTrade, they sell a lot of index options, straddles, strangles on various indexes. You basically eat like a bird and you shit like an elephant. Like it's really, really tricky to stay with those systems, especially when there's like market uncertainty. Now, the next bullet is no longer true. Like in the old days, commissions ate at least half of the profits, right? Because you're doing so many trades, and even with interactive brokers where commissions were low to begin with, you're basically paying the broker most of your money, and you're just banking a small subset of that, not on a per trade basis, but if you look at it over years and years of income. And then you missed out on the biggest gains, which often happen in a bear market. So, sometimes you would quantify the system and say, hey, what if I don't trade it just in a bull market? What if I trade it in a bear market? Well, then you're changing a lot of the system parameters altogether. So it's a good system to initially get started with algorithmic trading, to backtest, to get your head around this whole thing. But it's not necessarily a good system to really bank your entire life savings on. Now, when it comes to backtesting, typically what you want to do is you want to very quickly figure out if this idea is worthwhile, if this idea passes the sniff test. So I saw Adam posting, he's using this platform called TradingView, and I figured, let's give this a try. And immediately, on the TradingView platform, I found that this allows me to backtest certain things way quicker than with my existing trading framework, right? Like I'm doing a lot of it in Python. There's way much more work needed in order to code this in Python. There may be some room to actually test this in an actual higher language, in a higher framework that allows you to very quickly identify whether or not, this particular system based on your custom indicator or whatever passes the sniff test. When you do that, you want to start out with a household name, right? Like if I go back and I coded this in Thinkorswim, so you see the buy signals, you see the sell signals, you want to start out with how does the system perform on stocks like Apple? Okay, I buy here, buy here, buy here, sell here, looks good. I buy here, I sell here, looks good. I buy here, buy here, buy here, sell here. Well, there was a loss, right? But you want to backtest this so at least you very quickly see whether or not that system has legs to begin with, because it doesn't make a lot of sense to code it out and completely automate it if it doesn't look like it's going to make some money to begin with, because all you're doing then is automating the loss. And obviously, if you automate it, your loss is going to rack up much quicker than your gains. So that's how I basically do this. So the way I trade, and let me jump into this, is I basically trade as delta neutral as possible, meaning not delta neutral as in I sell options, because that's delta neutral when you put the trade on, but 10 minutes later, it may not be that delta neutral anymore. I do a lot of pairs or a lot of spread trading, meaning I go long one stock, I go short another. So with that, I do 80% mean reversion trading, meaning it's going to go back to the mean, and I do about 20% of trend following. Most of my trading is automated, but some is still semi-automated, especially for strategies that are in development. So you always want to have a pipeline of ideas. Once you coded that strategy, you want to go to the next one and see whether or not that's worthwhile doing it. And I mostly trade on equities and very little on options. And like I said, I trade highly leveraged, so I use the full portfolio margin leverage to calculate my return. So a system that generates, let's say 10% return that has just 1% drawdown, when you lever it up 5 times, it has 5% drawdown, it has 50% return. It's definitely a good system to trade. Now, before I show you guys some of the stuff that I'm doing, let me quickly explain what pairs trading is. So pairs trading is, you look for equities, like in this case, it's Pepsi and Coke, and they kind of move together. They're in the same segment, they're in the same market. So when the spread between Pepsi and Coke widens too much, you buy the underdog, you sell the overachiever, like in this case, you short Coke, you buy Pepsi, and you wait for that spread to return. Now, the way this looks on a chart, and this is why I'm using line charts and not candle charts, because many of the brokers don't really have that capability to do candle charts on that. A lot of the systems look like this, right? So this is a 1,000-day moving average. This is Disney against SNN. I have no idea what SNN is, but it's 13 shares of Disney against 55 shares of SNN. So when I get a signal here, like this green arrow, I always trade it mean reverting. So I'm looking for stuff that's at least 1 or 2 standard deviations away from the 1,000-day moving average. And if I get a signal, I basically revert that signal. So in this case, there's like 3 sell signals or 3 sell signals. So I would sell that trade. Selling that trade means I'm buying 55 shares of SNN. I'm selling 13 shares of Disney. Now, if it's below it, here are my buy signals. So I'm buying it. It reverts back to the mean. So every single one of those one lots would be I'm buying 13 shares of Disney, I'm selling 55 shares of SNN. The reason why this is completely delta neutral is, if we have the coronavirus and the stock market dumps by like 50%, this system could care less because it just looks at the relationship between those 2 stocks. If both of those stocks lose 50% of value, the system, the spread is still the same. So I look for those symbols that basically look like this, right? Like they highly oscillate around this line, and I'm basically always fading it back to the line. So I'm looking for the signal here. Like here, I'm a little bit in the hole, and then I'm waiting for the signal to basically fade it back. So here's like an ETF, the FXI is, I think, the Chinese ETF against Morgan Stanley. So again, you see this relationship. Now, this relationship can also go out of whack, right? I mean, this is not a surefire trading system. So here you see XLK, which is an ETF that is very technology oriented, against QQQ, which is the NASDAQ 100 index fund. So you see in this period here, this was trending really closely. So you could sell it, buy it around the 1,000-day moving average was really good. But then all of a sudden, this trade started to divert. And, at this point in time, I was in the hole big time. And, then early February hit and coronavirus hit and everything came back to normal. So I got lucky and got out of the trade. But there was a huge drawdown there. So this is how I trade. Now, like I said, what you can very quickly do is, and I wasn't familiar with that platform at all, but TradingView is also like, it lets, like it's a paid for service, but it also, first of all, lets you chart those pairs trades, right? So there's not a lot of platforms out there that let you chart those pairs trades. So let me remove the volume there because, I'm not a subscriber of TradingView. Oops. And don't know much about the whole thing to begin with, as you guys can tell. But if I take this pairs trade, for example, Disney versus SNN, or let's do this one, and I paste, let's do the Disney one. And I paste it in here, what this TradingView platform can do is it can basically visualize this pairs trade, right? So I can say, show me 5 years worth of data. And I see, yep, this also oscillates very much around the same parameters. Now, what I really like about this is I can go to this function here and I can say, RSI, here's a RSI strategy. I'm going to put that on. I'm going to optimize that strategy a little bit. So I'm going to say, instead of the 14 days RSI, I'm going to do a 2-day RSI. I'm going to say it's oversold at 10. It's overbought at 90. Give me the chart. And I immediately back test it and see what would my equity curve be. And it looks like, it would have been really good up to a certain point, but at least I can use that as a quick sniff test. Does this system actually look like, it's worthwhile investigating to begin with? So like I said, that's what I learned from the group here already, that there's other platforms out there. I wasn't familiar with them. And that's what the capabilities of some of those free platforms are. So it's a very quick way for me to now do like at least a sniff test on this system. So I would see, okay, overall, here's my profit, here's my drawdown, it would do all of this. It looks like it worked really well until late 2019. And then after that, the system fell, off the cliff, right? And I don't know much about this platform at all. Like, I don't know how to back test longer periods of times and things like those. I'm pretty sure you would have to pay for some of that since they want to make some money as well. But bottom line is that there's a lot of stuff out there. So before we jump into the questions, I wanted to leave you guys with a couple of different resources. So a really good aggregator of different algorithmic trading blogs is this website called Quantopian, and we'll upload the presentation at the end into the chat room. The data provider I was referencing is called Quantopian. If you guys just want to listen to the podcasts where people do very similar things, there's a podcast out there called Better System Trader. If you are looking for a platform where everything is already incorporated and where thousands of people backtesting stuff, there's a platform called Quantopian. Like I said before, I do have some serious, trust issues. So I never test anything on those hosted platforms because I feel like all they do is look for strategies that would make some serious money, and then they would start trading it rather than me doing this in Python. But this is probably me just being paranoid. There's a really good book out there. It's called Quantitative Trading Business, or How to Build a Algorithmic Trading Business. The guy's name is Rsi Strategy. You can obviously get it on Amazon. So with that, let me unmute everybody, see what kind of questions we have, and more importantly, see what you guys think about this whole thing. So I think everybody should be unmuted at this point in time.
Wow, great presentation.
Yeah, really good. Thank you very much.
Yeah, thank you.
Yeah, I've been looking at doing this.
Also, and really thorough. Really well done.
Thank you.
So have you tried running your strategies on just SPY alone? Because you're talking about different equities and different things not responding well. I kind of always, when I find myself trading and things are not, I always just end up reverting back to SPY just to get consistency in price action and things like that. So
I always test everything first on SPY, and then on super highly liquid stocks like Apple or Tesla, or the household names that you are obviously aware of, right? Mm-hmm. So here you would see, here's a buy signal, here's a sell signal, here's a buy signal, a bunch of buy signals with SPY. So it looks like it would work, but then you see this here, right? This is when the coronavirus hit. So this would be the RSI 2 trading system. Eventually it recovered for most of it, right? But if you guys remember, a couple of weeks ago when we were down 400 S&P points lower than where we are right now, you would have some serious drawdowns. But yeah, I always eyeball it first on the super highly liquid stuff, and then from there I go down the market and segment it to what if, because it's really hard to let go of an idea. At that point in time, I go down and basically segment it and see, does it work maybe on lower, volume stocks? Does it work on, stocks below $5? Does it work on this? Does it work on that, right? So eventually I segment it out, but initially I always go for the, super highly liquid stuff as well.
Yeah, I was having the same issues with the Connors RSI where I would see enough entries out of it. But then when I was sitting there looking across one just in the screen, I'd be like, okay, so I'm bypassing that one. I'm bypassing that one. And so I was just, through my own visualization, I was filtering out all the inconsistencies to it. And so I just finally stopped using it. So how many trades would you say your automated system has opened and closed?
So I do, with that mark-to-market accounting and trader tech status, I do about 6,000 trades a year. And, this is for 12 years now. So obviously, the number fluctuates a little bit, but on a daily basis, that this is a demo account, so I can't show you my actual account, but I think on On my actual account today, just on Thinkorswim, it probably did about 25 trades. And then on Interactive Brokers, it probably did around 7 or 8 trades.
Gotcha.
Have you done any research on earnings trades with options, selling options?
Yeah, so there's the TastyWorks strategy, right? You sell the straddle, well, I guess you sell the market maker move. I tested that, and this is I don't want to shit on the research that some of those guys are doing, but I cannot reproduce the results that they are seeing. So you definitely have more winners than losers, but when you have a loser, and you see this even in live trading with Sosnov sometimes, right? Like that loser eats like 10 of your winners and 10 some. Like there was what's the company? Netflix was one of them, where on earnings, like it sometimes completely blows out of that market maker move, but it's kind of like a symbol, like a watch company. Fossil, FOSL, I think is the symbol. Like this one, there was one move where it was like 4 times the market maker move or something like that. This may have been the move, like on this earning here. And, like that one trade kills like 10 profitable trades, right? So it's very hard to size that up because, if you say, hey, from my first trade, I made $100, from my second trade, I made $100. So I'm taking and reinvesting that into subsequent trades. And then you have a loser like this, it'll take you 2 years to dig yourself out of this. So it's really tricky to do that.
Well, I found that using a semi-defined risk works a lot better because I got toasted pretty badly. But the defined risk or semi-defined risk, maybe if you're selling 10 and then you buy 5 out of the money or something like that, has been pretty steadily profitable.
Okay.
But that's a short period of time. It's only like 3 months. But
Options Alpha actually just did a podcast on earnings trades, and basically the consensus was just don't do it. Yeah. It just doesn't end up being profitable. So.
And then you have other guys like I think Goldman Sachs did a back test on this as well, and basically said you're better off going for the outlier. So you may just have one winner out of 10, but that winner is so much bigger than the losers. And that back test came out also like a couple 3 years or so ago. But basically they also mentioned that it's better to do it, to actually not do the selling the option, but actually going long the spread, because like 1 out of 10 or so typically completely bypasses the market maker move. The tricky piece with especially with automated trading with a spread, when it's not an equity spread, is the fill. So if you put on, especially like on that Fossil, for example, right? It's not heavily traded. It does have some decent volume, but if you put on a spread, it's really tricky to get filled in an automated way because you need to, first of all, calculate the mid price of both of the legs. And then based on that, you submit it to the combined order book. And if somebody hits that, they want that trade. Like they literally want the combined trade. You're almost better off submitting it as 2 individual legs, but then you again have the risk that only one leg gets filled and the other one doesn't get filled. So it's not easy. The second you get into options, like one of my most profitable systems was just selling straddles. And then May 6, 2010 happened, the flash crash happened, and all the spreads would go through the roof. And basically since that time, I very, very rarely sell options completely automated.
Yeah, the only way that I could really see options fitting in algorithmic so far, without diving too deep into it, would have to be in the money. It just for the and also with plenty of date to expiration and just a call or a put. I don't see how you could really do it any other way. Is there anybody out there that is doing algorithmic option trading?
Well, I'm sure all the counterparty when you enter the trade manually. That's all algorithmic, right? Like you get basically trading with the computer there. Now, what they do better is they basically do two things better. One is they understand, the spread better, and they usually hedge it right away. So, if you sell, let's say, like a 20 delta option or 23 delta option here, first of all, I mean, you need to look at the spread right now, right? Like that system, and again, this may be because the market is closed, but obviously that spread is crazy wide, right? Like even if you get filled at the mid price, you don't know if that is a fair fill at all. And then you'd have to hedge right away. So I do think that there's some alpha out there right now, mainly because you can hedge for free with the underlying, while before every single trade you did, was like $5 with TD Ameritrade, was $1 with interactive brokers to get into and out of. And now you can much better automate this. But I do think, your own market making strategy compared to what the big guys like the Citadels of the world are doing, it's not going to be comparable. Like those guys will always outperform you. So unless you have at least a little bit of directional bias, I think you may as well just sell the at the money straddle all the time and hope for no movement.
Gotcha.
But, I kind of think of myself sometimes, I'm not sure how many of you guys saw this thing on Netflix called Tiger King. So there's this guy Bhagavan or whatever, Dr. Antle, and he lives in his own world, right? And he has his own rules and he has a bunch of, women that work for him and stuff. And his child says he lives in his own universe. And sometimes I think the same about me. Like just because it doesn't work for me doesn't mean, it doesn't work. Like I sometimes feel like, a lot of this is self-taught. A lot of this is trial and error. And just because I ended up there doesn't mean that that's the only way of doing it, right? So take everything I said today with a grain of salt and make sure that you back test it and do whatever you think works for you. But I ended up there through many, weird turns, and I literally do the best right now with that pairs trading because it reduces completely the market risk, and it's pretty idiot proof, to code those systems and to visually see whether or not that is a trade that, makes sense. But even with it, like I said before, right? Like there's one trade I have on right now, but in futures, like this is the S&P versus the Russell 2000. If you look back for 10 years, this guy, was in this range here, right? Like right where my mouse pointer basically shows this horizontal line. Like it was trading above and below that line. And all of a sudden, it started to completely fall off the cliff, right? So based on my thing, I'm assuming it's going to come back, but I don't know. Like this is my worst performing trade for the year. Like many of the other ones rotate, but that doesn't mean that they, rotate consistently. Like there's always times when this goes out of sync. And if you want to automate that testing, right? Like, it's very easy to visually see that and get the signals there. But if you want to automate that, this is called co-integration. So co-integration is a test. There's like two different tests. There's one called Advanced Dickey-Fuller test that basically checks whether or not the time series is stationary around a particular, zero line, and you get the mean square root error and all of that. So it's a pretty comprehensive test, but even with that, like sometimes you can just look at this and say, yep, this definitely looks like, it's something that hasn't diverged for quite some time.
So have you limited the number of entries? So some of those, like you have a sale 10 times in a row before you have a buy.
Yeah, typically, what I do is typically when I get a signal, I don't take the signal, for at least another week. So some of them are on shorter time frames, but like here, for example, right? Let's say this one is not far enough from the standard deviation, but let's say you look at those three, if we zoom in here a little bit, you see that there's a signal and a signal and then three more and then two more. I would take this and then I would wait a week and I would probably ignore those and then would take this one again, right? So at this point in time, I do add a discretionary element to it so that I don't get over-levered in a single position. And then this is just, again, you want to spread the risk across many small positions, just like the casino likes you betting, $20. They don't like the guy who comes in and bets 20 grand on black, because the small outliers skew the overall total return. You want to have many small wins, and that the zero commission structure with the brokers now made this way more easy, in my opinion.
Mm-hmm.
Have you read about Jim Simmons?
Yes.
Renaissance Capital?
Yep.
He's, what you're saying is what he's done, and he's compounded big money at 60% a year for 30 years, and he's always looking at new systems, always tweaking things. He said what worked 10 years ago doesn't work now, and there's all these.
Yeah, and that's definitely true. So there is a system decay. When you find something that works, it's not going to work forever. Like most systems that I've had typically had a lifetime of roughly 2 years. Like some of the ones where, you may get luckier and they may be 2.5 years, maybe 3 years where you can trade that system. But eventually you see it plateau off, like you'll see it level off. And at that point in time, you want to make sure, as it comes down and becomes a losing system, you don't spend too much time with it. So what I typically do is for every system, I put a trailing stop in place. So let's say if this was my P&L for one system, right, I would do my trailing stop. And once, let's say my P&L goes up and the system just performs great forever, and then eventually it drops, at that point in time, I would say, okay, this system is done. I'm going to get rid of it. And then I may just shelve the system and, try it again, maybe 6 months down the road, maybe a year down the road. But a lot of the systems, especially when they are directional and they are single stock systems, you want to make sure you at least get the overall market regime right, meaning, some systems perform better in a bull market, others perform better in a bear market. For pairs trading, this doesn't really make much difference, but for, individual stock trading, this definitely makes a huge difference.
So I'm usually on the, oh, go ahead, Adam.
No, go for it.
Okay. I'm usually on the sell side. So what I typically look for is I look for like the outlier in the bids, right? When I'm selling something, because I know I can get filled because the order's out there.
Okay.
And, I'll be looking at like, all the strikes as you're going up, and then they'll just be like, boom, one that just sticks out. And typically it'll be pretty far out of the money. And I know I can get it filled, and I'm looking at like a good probability of profit on like that sell. So what do you typically use? Are you using like the mark? Like what are you looking for in terms of like your fill criteria for getting
Yeah, so I usually go for the mark. So, when you ask for an option quote, you basically get the bid and the ask. You add it up, right? You divide it by 2 and you get the mark or the mid.
Yep.
And then based on that, you may fudge it and you may add a penny or 2, but I don't go more than that. If I don't get there, then I don't go.
Yeah, I haven't had any trouble filling most liquid stocks or options. With when you go just a penny or 2 above the mid. I mean, unless some of them have really bad liquidity, then I just steer clear of those. But
I mean, I usually end up with stuff that's not super liquid, just because it's so far out of the money that's no one's trading up there.
Gotcha.
Like, yeah.
So do you go just for the ones that have like weeklies, or do you go for like completely exotic things like, I don't know, like most of the ones where I trade options, they all have, weeklies. So and once they have weeklies, they do seem to have, fairly decent liquidity associated with them.
It's mostly weeklies, but it's pretty far out of the money, and it just ends up being where there's not a ton of volume. And, I could put something out at the mark, but it's like the chance that I get filled within the weekly or 2 week frame is just like, it's not good enough where I'm comfortable, but I'm comfortable holding it because I'd be comfortable buying it at that price or selling it at that price. But it's just, I'm not likely to get filled.
What I do there is, when you calculate the mid, right, and you say this is my mid and this is where I put on the order, you get the reference back to the order, and then you just constantly increment it by a penny or 2 until you get filled, right? And obviously you want to be within your risk criteria, but that's definitely something that is completely free for TD Ameritrade. I think you pay like a penny or 2 for the canceling on Interactive Brokers, but that's one way to avoid that a little bit. So you can put it on, sit there, and then I usually have a random number algorithm. So it doesn't like always after 30 seconds increase it and then 30 seconds increase it and 30 seconds increase it, right? I say somewhere between 10 and 30 seconds. look for it, and if it's not filled, get like a random number, wait somewhere between 10 and 30 seconds. Let's say it's 20 seconds now. The next time it's like 15 seconds, and then it just walks up the chain and basically tries until it gets filled. But then again, you want to make sure that you're comfortable with that fill, right? You don't just chase it up and then get like a super bad fill on that.
Okay.
I've got a question on your pairs trading. You may have touched on this already, but how do you choose the weights? So here you've got 13 DIS and 55 SNN. How are those chosen?
Yeah, so basically they all come, so here is, for example, this is where I stage them. So every night, like you'll be able to see that actually, like right now, it's loading all those quotes. It downloaded all the quotes earlier today. So right now they're all basically being pulled. So this is that server from that company called VPS Time, right? So my SQL process there is being hammered right now by the Python script that's basically loading this. And then once this is all loaded, which is typically around 9 o'clock Mountain, at 10:44, the screening happens. And what the screening does is it weighs those stocks. And, for example, let's do this in SNN. So let me see if I have Excel here. So the way I do this is I take, let's say I'm going to put on a $10,000 position in each one. So I'm going to do $10,000 here. Well, let's do $1,000. And then just $1,000 on the second one. And this is going to be Disney, and this is going to be SNN. And this is not using the beta here, like I calculate my beta on my own, but SNN would be 37.71. So it was 37.71 was the last trade price. And then Disney was, let's say, 103.37. 103.37. And then Disney has a beta of 1.01. So you see that here. And like I said, I calculate that in the Python code, so I don't use the Thinkorswim beta. And then SNN has a beta of 61 of 0.61. So then you would do the $1,000 divided by the stock price divided by the beta. So you would end up with a ratio of 9 shares of Disney and 43 shares of SNN, which is probably very equivalent to the 13 and 55. So I don't think there's any, intellectual property in how I calculate the beta versus how Thinkorswim does it. It's just I don't want to hit Thinkorswim for each and every beta value, and I want to make sure I take advantage of that, right? But this basically says 9.57 shares of Disney is the same as 43.47 shares of SNN compared to the S&P 500. So that's how you end up with that ratio. Does that make sense?
Got it. Yeah, thank you.
So where do you download that stock data from?
So I get the stock data from, let me move this to the side here, from this company called Quandl. And they basically, so this is one of the podcasts I was mentioning, Quandl.com. So they have all kinds of data there, and it's all the core financial data. So you get an API key, and if you get a free account, I think you get a limit on how many stocks you can download. But if you pay like $40 a month or so, and each and every one of the data packages is like between $40 and $100. So you want to make sure that you choose your data wisely. But obviously they have US option data, they have continuous future data, they have like all the data you could possibly think of, and that's where I downloaded.
So you just download like the whole history every day, or?
Yeah, I basically download everything. So if I do, I may not have, because it's loading the data right now, so I may not be able to show you the data there, but let's see.
So you download like 7,000 CSV files and then stick them in my
Yep, pretty much. So if I go to
I'm a Python developer, so I love this.
so I have this subfolder in here called data, and you look at the data there, they're all, downloaded like today at 8:17, for example. And if you do a ls minus LA and you see how many files there are, like 6,832 files had valid quotes. So I'm downloading all that data. And if I, look at one of those data files.
So that's how you take care of all of the splits and dividend adjustments.
Right. So what it does it has a column called adjusted close. And the adjusted close, don't look at this. This is the volume. This is actually the adjusted close. But this is the dividend adjusted value. So here, high, low, open, close is the actual what it traded at that point in time. Obviously, for the most recent time, this may be the same or may not be the same. But the adjusted close is basically the dividend adjusted value. So if you just go based on adjusted open, adjusted high, adjusted lower, adjusted close, you basically have the dividend adjustments in there. If you go to finance.yahoo.com and you look at that data set and, let's say SPY, you also get the data there. You only get the close there. Whoops. Yeah, that unfortunately that website is not what it used to be. Like that website, whenever they got bought by Verizon or whatever, they went through a lot of crazy stuff. But anyway, on the historical data tab there, if you download that data, you also have an adjusted close. You don't have an adjusted open, an adjusted high, or an adjusted low, but from the adjusted close, you can figure out what the delta is, and then you can make the low, high, open, the adjusted low, high, open, right? So there used to be a time when I only downloaded it from Yahoo Finance, but now, like I said, I basically download this, and I can definitely share. Like if somebody's interested in that data, it's about 200 megs or whatever, I can share the database, no problem.
Just go ahead.
Yeah, I cannot share the raw data, and obviously I cannot share my API key that I pay for, but I can definitely share the data. So if you have a good strategy, and or if anybody wants to collaborate or work together or whatever, I'm definitely game. But even if we don't want to work together, you just want the data, just ping me, and or I can just upload it to the Slack channel. So it's pretty straightforward. But based on this, you can obviously see the data. Now, it's always going to be the same on the most recent stuff, right? But if we go back 3 months, then what you'll see is that the adjusted close, like here was the dividend adjustment. You see on April 5th was the dividend. And then, actually, this is on the SPX. This is not on the, this is on the future. So there's no dividend adjustment on the on that. But let's put like a different symbol in there. And like I said, the website is not what it used to be anymore, but you'll see the difference in the dividend data there. So here the adjusted close matches the close, right? But then when you go back and you look for the last dividend adjustment, whenever that happened, like here was a $1.57 dividend, all of a sudden you see the difference there, right? Like it traded at 320.90, but because they paid the dividend, it's as if it would have traded at 317.46. So this is the close, the actual close, and this is the adjusted close based on the dividend. So all you care about is really that adjusted close column there. That takes care of the dividend adjustment. And then if there is a delta, right? Like in this case, it's what is like $3.44 or something like that. Then you can add or subtract that from the open, high, and close of the actual trade price, and you would get the adjusted open, high, and close based on that.
So would this be on the ex-dividend date or the actual date that you get the dividend?
So it's the day after you get the dividend. So in this case, I think the dividend happened on 20th, and the ex-dividend date was the 19th.
Okay.
So on the 19th, you would have had the right results, right? On the 20th, it basically would have to refactor the entire, time series data and readjust the data based on the dividend you got paid.
There is another data provider which calls premiumdata.net, and they have only $25 per month, as I remember, and they have updated and adjusted that data for 20 or maybe 30 years, including some stocks which are not on market right now.
Yeah, so That's a good point. So when you get any kind of data set, right? That data set is usually what's called, that data set usually has survivorship bias, right? So in my data set, I don't have Bear Stearns, I don't have Lehman Brothers, because they went out of business, right? I don't have a bunch of the oil companies, not the oil, the coal companies that went out of business. So ideally, you have a data set that includes those, because some of the strategies where you basically martingale, right? You average, you double up and you double up and you double up. They will always backtest really great on the data you have, because all those stocks are still trading. But some of them, that went out of business, obviously that system would have blown you up. So having a data set that does not have survivorship bias is definitely valuable. Quantal, I think, does that. But that is something that I ignore completely in my data set. So I look for highly liquid symbols there, especially for the pairs trading. A lot of those are fairly liquid symbols, like XLF and XLI. Those are two huge ETFs, for example. They trade millions of shares a day. I'm not sure, like 63 million shares, and XLI is like 12 million shares. So I don't worry about them going out of business anytime soon. Obviously, that doesn't mean that it's not going to happen, but for the pairs trading, there is a natural hedge basically built into that.
I'm just curious, from the architecture point of view, do you have a separate table for every stock, or do you have one table and you? No,
I got one massive table, and it's being loaded right now. So if I look at it, we may not get any data off there, because it's in the process of being loaded. But let's see. But this is basically the data structure, right? It has a symbol, an open, a close, a high, a low, a volume. Then what I do is I calculate what's called the price volume. So for example, if I have a volume of 1 million shares on a $10 stock, that's different than 1 million shares on a $100 stock. So I use that very often to filter it, and then it just has a unique key.
So I do something similar, but I do it basically on a per stock basis, and I do it like, say I'm looking at Boeing, and I put in Boeing, it'll pull that information when I ask for Boeing, and I'm going after Yahoo Finance, and then TD Ameritrade to get the options chain. Okay. Basically, what I'm doing is I'm looking at like, okay, what's got open bids, because I'm usually on the selling side, and then I'm basically looking at like, okay, if I'm going to put some money at risk to sell an option, how much am I going to get for that? Turn that into the probability using the IV and a couple other things. And then I basically have like some filters that end up turning that row green. So I'll know like, okay, that's something I should look at. So it's not automated, but it is something that like, I'll basically do the wheel strategy on it, using that as the, the basis for picking which strike prices I get in at.
How do you get the IV? Do you get that when you ask for the option data directly from TD Ameritrade? Is that part of the return set?
Yeah. So basically, I grab it out of the options chain, but then I calculate it out to figure out what the probability is using the. I can't remember what the formula is, but it's like the standard formula for using like IV to get to the probability.
Okay. Yep, no, very, very similar approach. So, and I mean, have you found a lot of issues with the Yahoo data? Like a lot of people on the Reddit groups and, various chat boards and message boards, they complain that the data is that bad. Like if it's that bad, you'll typically know, because it's like, it has a 0 in that line, right? Like the open bid is 0 or whatever. And then you just need to handle it in your code.
So that's the thing. I gave up on using them for options chains.
Okay.
So I just get the historical prices from them.
Got it. Okay.
And then I get the options chain from TD Ameritrade, which since I have Thinkorswim, I just use my API key.
Mm-hmm.
So I started with just using Yahoo Finance, and then I ended up with the problem like I'd go get the data, and then I'd hit my API limits or whatever. I just wouldn't get anything back. So now I've switched it out, and now if I just get the historical stock history, I have no problems with Yahoo Finance. And then if I go after, TD Ameritrade for the options chain, I typically get a better quality options chain where it's like, if I go to Robinhood or Thinkorswim, I'm more likely to get my option actually filled at that bid price.
Right. And then how, because with the, I guess, new data, like with the new API, right, with TD Ameritrade, you always need to ask for like the current token, the current refresh token, and the current access token. Like, did you convert over to the new API where you basically have to ask for the token and then include the token for every subsequent request? Like it changed quite a bit, the TD Ameritrade API.
Yeah, so the token that I use is good for 90 days. So I've automated the job to refresh my token.
Right. Yeah, I do the same thing.
Yeah.